Welcome to the STR Data Lab.
Hello and welcome to another edition of the STR Data Lab. I'm Jamie Lane, Chief Economist at AirDNA, and got a special edition of our podcast today. We are playing a recording from this week at the Data and Revenue Management Conference that was held in Sandestin, Florida. And this was a fireside chat moderated by Simon Lehmann with myself and Pedro Borges, the Director of Data Science at Price Labs. In today's podcast, we sort of dive into what's the expectations for 2026, what's happening sort of behind the headlines, demand patterns that both us at AirDNA and Pedro, what he's seeing at Price Labs, some of the changes we've seen in the data around fees and how that's impacting things, how we expect actually major changes in the OTAs to evolve over time. What are KPIs that we're focused on and maybe others should be focused on as well, which maybe KPIs are overrated, and some, I think, really fun banter on what's happening in the industry today. So with no further ado, I hope you enjoy.
All right. Fantastic. Let's kick this live stream off here at DARM 2025 in a beautiful destination, Destin, Florida. I have Pedro Borges from Price Labs and Jamie Lane. That doesn't need introduction from AirDNA. Wow. Pedro is the first time I met Pedro today. It's actually quite funny. I think I've seen Jamie some years more often than my own children. So that's what we do at the conferences, right? So let's talk about data. Let's talk about 2025. That's what we're going to talk about, and what is data signaling. Also looking out in the future as well. Sure. We've seen an interesting presentation from Jason and Melanie this morning as well. And it's been obviously very US centric, and this live stream is maybe also some international attendance as well. So we want to look at it a bit broader as well in general. But maybe as a start, Pedro, how, from a data standpoint, how do you view 2025 and what did you read out of that?
Sure.
You know, this is a hard question because everybody says it depends, right? Yeah. Destination, everything else. But how would you summarize 25?
Gotcha. Okay. And you want to know in terms of like the technical side of like data, or do you want to know about, market trends? What do you
Market
think?
trends.
Market trends. Sure. I mean, I think that we're coming, I was talking to Jamie earlier today, and I think we're coming to a point where things are stabilizing. So, there's been a lot of volatility in the last few years, but now things are kind of coming to a steady state, right? And the supply is kind of becoming more steady, right? The demand is also a little bit more steady. So, I mean, it's hard to talk about in general because, of course, markets are different. But that's one thing that we're seeing.
So the stabilization, I want to pick that up quickly.
Yeah,
so you go a little bit deeper. I mean, that means we're seeing less fluctuations in terms of the classical STR metrics.
Yeah, essentially. So we're seeing like some stabilization in terms of like RevPAR, like occupancy and even ADR, right? And so I think that means that property managers have to manage their listings with that scenario in mind. So they have to think about, hey, how do I differentiate myself in a situation where, I can't just, take advantage of a really favorable market condition where people haven't entered the market yet, right? And so that's where, becoming more professional, right? Using, good tools, right? Learning more, I think becomes really powerful, right? And I think maybe we can talk about this later in this chat, but I think that's an important point for 2025 and going into 2026.
Was it a market correction? Would you call it a market correction in 25? When you hear what Pedro says, how did AirDNA look at that?
Yeah, and we see it the same way. And occupancy, for all intents and purposes, was like flat this year.
Yeah.
But then, and I love this analogy of like a rising tide lifts all boats. Like we saw that in 2020, 2021. Yeah. And then there's an analogy when the tide goes out, like you see who's not wearing their swim trunks. Like we saw that in 2023, 2024. And now in 2025, like it's about stealing share, right? It's like a pirate fight out there of like, how can I steal from someone else? or how the market trends actually dictating who outperforms versus underperforms. And as Jason and Melanie showed this morning, like the K-shaped economy is real.
Yeah.
And that's not just in the US. Like that is a global phenomenon. And we've pulled the data for Europe, for APAC, for LATAM, like luxury outperforming, budget underperforming. It's true everywhere. Yeah. And you think about the sort of top income producing like people in the US, like those are a lot of the people in Europe too that are driving the global economy, because travel is a global good. And you go to any country in Europe, like what is their top inbound country from? It's the United States. So the American traveler not just dictates US trends, but also dictates global trends. And then you have the opposite. Now what's happening with the European travel and the Canadian traveler really impacting US trends.
But I would challenge that. Is that so significant? If you look at a country like France, where 80% of the demand is French, right?
France is the outlier. In general, France, the UK, and the US are the ones that generate all their most of their demand domestically. But you go to just about every other country in Europe, like Iceland, it's 99% international.
Yeah, of course.
Yeah.
I mean, who would make holidays in Iceland, right, if you live there? So you want to go to a warmer country. But do you see the same phenomenon? I thought that very interesting, and I asked Jason this morning, is that the death from the mid-market?
Yeah, I mean, maybe, I think we do see the same phenomena, like, I don't know if I have much to add there, because I think exactly what Jamie said,
How does that result into on the supply side? One thing I thought was interesting this morning, when I saw Jamie talking about 14 million properties, right? And my number was always 10, so that's 40% growth in a way. But how is that going to affect the supply growth as well?
We'll clarify that number.
Yes.
Because we're looking at the same inventory. So 14 million properties, good number of those are cross-listed. Yeah. So just because they're cross-listed doesn't mean we still don't have to track them. Okay, so so throw in cross-listed, it's about 10 million out there that are
that's
live.
Still the number.
Yeah.
I'm glad. So I thought I'd say something wrong. So.
No, but standing up on stage, we're still tracking 14 million properties. Like it's a lot out there. And then you add in hotels and other listings, like there's a lot to track on a day-to-day basis.
So let's go a little bit deeper there, Pedro, as a revenue management company from Price Labs. How does that K economy, if we call it, and I thought that was an interesting expression this morning, how does that going to affect the pricing on these different tiers? Like you see different fluctuations on these tiers.
We do. I think that's maybe about difficult. Like that's one of the challenges of pricing, right? Because it's easier to price when you have a large sample size. So if you're in the middle, right, of the pack, you have a lot of similar listings, good comps, right? And so it becomes easier to price. But if you're like a really expensive, really luxury listing, then the number of comps that you have available it's a much smaller data set, right? And so we try to, and so you have to be careful about when you look for comps in that situation. And so, we're seeing that there are a lot more, there's a lot of growth in the luxury industry. Maybe that means that we'll have, larger comp sets for these listings, right? Because that will become a little bit of a bigger market. But it is part of the challenge of pricing luxury listings.
But with that mid-market shift that we're talking about, and said this is an underperforming market, and what did you hear? The millennials have killed the mid-market this morning. I thought that was an interesting point. How does that affect the market and the supply overall? Are we going to see a decline there?
Yeah. So right now we're at the lowest level of supply growth, like in a non-COVID period, than we've seen in our entire tracking of the industry. And that's true in US. We're generating about 3% supply growth. Like you rewind 3 years ago, industry was growing 20%. Like Europe right now, supply is growing like 3%. Like we've seen a big shift down in terms of overall supply growth. Then you sort of dig into it and you look at underperforming property managers and hosts versus outperforming. I'm saying in terms of review scores, this is where the middle is disappearing. If you're an underperforming property manager, let's say like average property manager review score is a 4.7.
Yeah.
If you're generating below a 4.7, you lost 3% of your supply this year on average.
Wow.
If you're an individual host, you lost like 5% of your supply on average. So if you're not, it's the OTAs sort of promoting the guest favorites, the top 1%, the top 5%. It's Verbo's now switching to premier hosts is being tracked on a property level basis. If you go and search any of these OTAs, booking included, if you're not getting one of these badges, if you're not a 4.9 or above, you're not showing up until page 2, page 3. And essentially, if you then do not have a direct booking strategy, like you're not meeting homeowner expectations and they're going to churn out.
And it's going to get worse because we're going to see more margin compression.
Well, I think there's an interesting scenario though where we do see some listing, not some, but Brian Chesky, mentioned on his latest call, like that he was seeing that professional property managers, they had a really low, star score, but they had higher, RevPAR.
Yeah, of course.
And so, so there are ways, right, of dealing with having a large star rating, right, while still maintaining higher RevPAR. And that becomes the strategy, right? That becomes the professional, that becomes what professional property managers bring to the table, right? Because they have the strategy, they have the knowledge of distribution, knowledge of pricing, right? So they can make listings that maybe don't get the best reviews perform really well. So I think,
Totally with you, and I agree. And I want to quickly pick up Jamie before, in terms of supply growth, really flattening out in terms of supply. But what you didn't mention, which I thought is interesting, you separate that. How much of that is regulatory driven?
Yeah, and in Europe, so much.
Yeah, that's
Spain listings are down 6%. Greece listings are down. Italy listings are down. So you're actually seeing contraction in the market, and it's primarily regulation driven. In the U.S., not so much. Like a lot of the markets that are seeing weakness and even falling supply, it's not because there's new regulation. It's because the markets aren't really performing. Home values are really high, and you just do not see new investors and people bringing on listings as much as they were before. You still see similar levels of churn. So, and there's so much churn that happens in this industry. So if you're not getting new people in, supply starts coming down. So there's a lot of markets where just underperforming, and it's a perpetual thing of all right, if I can't cover the mortgage, there's no point in owning this asset for me to use 2 weeks a year. So I'm going to get rid of it. And maybe the next buyer that's going to come in, they're willing to pay 10, 20% less, but they're not renting it out as a short-term rental. They're using it as their sort of leisure asset. And now the industry's lost it. And it was the opposite effect that we saw in 2020 and 2021, because home values were so low, interest rates were dirt and cheap, and listings were outperforming highest levels they ever were. We saw this massive investors come in, and now most markets, most short-term rentals aren't going to cash flow.
So the next shift I want to allude to that one is obviously midterm rentals as well, right? So from a short-term rental to midterm, and I would like to know from both, how do you track that midterm rental market? Because obviously you can imagine Barcelona, 257 property managers will move into midterm rental or they'll lose their property. How do you track that at Price Labs as well in terms of data?
Yeah, I think it's still a relatively small market. I think in our last estimate, it was 6% of listings were midterm rentals on Airbnb. And so not that expressive.
But there's other channels.
Yes.
There's in the US, Furnished Finders and others.
Fair enough. Yeah. That's but not people converting from Airbnb into midterm rentals. I guess that's maybe there's an upward trend there, but it's maybe something new, And so people are still thinking about hey, how to price it, right? There aren't really good, there aren't good solutions out there yet. So that's
Is that a segment that you guys are looking at more and more because of that shift as well?
Yeah, we are. We've been thinking about this for maybe a year now. And so we've been targeting that segment and thinking about pricing for those listings, right? So for them, right, you can't think about the same data source. You can't think about the same pricing algorithms, right? So everything changes, right? It doesn't make sense anymore to talk about daily price fluctuations, right? Because we're selling, 30 days at a time. And so all of that comes into how we think about midterm rentals.
Yeah, and the PMSs haven't picked that up either yet. So.
Yeah. So I was actually on the phone yesterday with Jeff Hurst.
Oh, really?
Jeff?
Yeah, I've had him on the podcast, so it's going to be streamed soon.
Yeah, so Jeff is the CEO of Furnish Finder, was the former head of Verbo HomeAway. And we're doing a big research report with them on the rise of midterm rental demand.
Super cool.
Yeah, and so where Pedro said only 6% of listings, like most listings though, you can't like bifurcate into short-term and midterm.
Yeah.
Like the managers that are doing really well, the homeowners are sort of blending that midterm and short-term rental strategy of, let's say you're in Boston and like international demand and peaks during the summer, like you've got so many people coming in, and then you get in the winter, like there's no tourists coming in.
Yeah.
But you've got all these doctors, nurses, students, and you can sort of blend in a month, 2 month, 3 month long booking, and where you're not going to generate a whole bunch of 1 day, 2 days. So that blended strategy works really well.
Yeah.
And then in markets like New York, Denver, Los Angeles, San Francisco, where regulation has come in, like short-term rentals are banned in New York. We've seen the overall amount of listings on Airbnb only drop about 15%.
Yeah.
Why is that? Like, it's not like the homeowners were going to all of a sudden bring it into the long-term rental market. They had reasons why it wasn't in.
Yeah.
And so now they've shifted them to midterm rentals. They're doing month, 3 month long stays at a time. And like, yeah, overall demand is down. Yeah, overall rates have cratered because the rate you're going to get for a midterm stay is not the rate you're going to get for a short-term stay. But we have not seen a mass return of listings back into the housing market for New York because these listings were never going to be long-term rentals to begin with.
All right, that's a good point. Yeah.
So let's talk about what actually matters in terms of metrics. So you guys are, I call yourself data nerds, right?
Yeah,
so,
of course.
but that's not the average in the hospitality industry. You're a very small minority in this industry. So, and we can talk about metrics all day long, every day, and we have all these abbreviations and it's overwhelming, but what actually matters? And I would like to kick this off with you. You know, what, like for a property manager, for a PMC, what metrics do really matter when they look at data? And is there going to be a shift that they need to look at things that they don't look at?
I mean, I think not, I mean, I think there won't be a shift. We'll see. But I think in general, the idea of focusing on these past data points, adjusted by leading indicators is generally the strategy, right? And what I mean by that is like, hey, how was I booked last year? What was the rate? What was the overall occupancy? And then adjust by pacing, right? And I think that's a really basic way of looking at a strategy that just works, right? It's worked for hotels for, 15 years, 20 years, whatever, how many years hotels have been doing revenue management. And so it has to work for, STRs as well. And there's no need to complicate that too much. I mean, there are other indicators that you can look at that could be interesting, but in general, I think that covers,
So what are the key metrics for you?
Key metrics: past occupancy, past ADR, and then leading indicators for future occupancy and ADR coming in, and that covers
So RevPAR is overhyped in our industry?
I mean, if you think of occupancy together with ADR, right, you get RevPAR. So I don't know, it's about the same. Yeah, I think it's.
Yeah.
How do you view that?
Yeah. So 5 years ago, I left the hotel industry to come into short-term rentals. And the hotel industry is pushing really heavy into GoPAR, TrevPAR, and essentially measures of profitability. In profitability, not measured at a management company level. Like, I know most property managers room, I care about how profitable your business are, but ultimately, this major stakeholders in this industry are the homeowners. And we do not have a key measure of how profitable it is for them as investors of these $1 million assets, $500,000 asset. Are they actually, in owning that asset, generating cash flow or not? And ultimately, if they're generating profits, they're going to buy more short-term rentals. Yeah. They're going to add more inventory into those existing property managers. It's not like they're going to hire 20 property managers for the 20 different assets. They're going to hire one and generally let that person run if they're doing it profitably. And I think a better measure of like all the expenses that go into running a short-term rental, like, and it's not just your management fee, but it's insurance. Insurance has been crushing homeowners over the past 2 years.
Yes.
Property taxes have been crushing homeowners over the past few years. And if you not have a holistic view of like what's actually impacting your homeowners and their ability to continue to operate these assets, like, I don't think you're a true partner with that homeowner. Like, I think many of us say that we are.
So while the market is more compressing, we need to think more harder about profitability in general, right? And now we have also OTAs ranking up fees and changing fee structures, and that has a massive impact as well, right?
Yeah, for sure.
And it's had a massive impact on our data.
Yeah, it has.
Yeah, and we both
So
track.
explain that just quickly.
Yeah, so the OTAs moved to essentially all-in pricing. So any guest that goes and searches Airbnb, Vrbo, instead of seeing the nightly rate and then a breakdown for the cleaning fee, the service fee, the admin fee, the
Booking fee.
And
Damage waiver fee.
And it was, and we were all seeing it on TikTok, Instagram, like everyone complaining, like, I go and book this $100 night rental and it ended up being $500, like, for a single night. Like, how does this happen? And I was like, well, you booked a property with a $350 cleaning fee. Like, that's what happens. Like, short-term rentals aren't meant to book for one night. But essentially what I think the OTAs found was that if you hide those fees and not display them, like, customers actually convert better. Like,
They can't commission it.
and so when you go and search and you see that $500, like that's going to be the $500 maybe with some taxes on top that you end up paying. And that by nickeling and dime and adding all that up when you go to checkout, like you lose a lot of people in that checkout process. So they made that change. It absolutely impacted how we collect the data. And we had make a lot of changes through our process, but ultimately, like at our DNA, we've always included cleaning fee in the total revenue that we report back.
Yeah.
Because our goal was getting to what is host take home amount. So we're excluding fees. So all this changes in fees, like we just had to make sure we're tracking it the right way.
Yeah.
And ultimately it doesn't impact our revenue or our ADRs that we're reporting back. But if you go and now look out at on total prices and the rates that people are sort of reporting for your competitors, you do need to have a sense of like what their fee structure is, what their cleaning fees are, and that really helps get a better understanding there.
Yeah.
How did that affect your algorithm as well?
Yeah, I think it's similar, like it changes the way that we collect the data and that we display the data, but we try and do it in a way that doesn't affect, anything else, right? The underlying platform should continue working the same way. We do think that, there will be a time when we won't be able to like estimate very well some of these fees, right? So cleaning fee, service fee today, we're able to get it, but there might be a time when we aren't. So we're moving towards like an all-inclusive type of fee. So we're migrating, we've been testing, some changes and we're migrating everything to all-inclusive eventually.
Are there any questions from the audience at all? Any questions? This is your chance.
In our market, we'll do a lot of length of stay. Do y'all is there a way that y'all are able to capture that when you're doing screen? Okay.
Yeah, we do.
So the question was, if they capture the average length of stay and length of stay, right?
Yeah. Like 10% discount for weekly stays, that kind of thing. Is that getting picked up in comp sets?
It does, yeah. So it does like increase the complexity of collecting that data a lot, right? Because now just a date doesn't have a price, right? It has multiple prices depending on the length of stay, but that's part of the scraping that we do is we determine what's the price for different lengths of stay, and so it captures that.
Yeah, and we do the same thing. So when we do a scrape, we'll see like a 10-day block go unavailable. We'll then group all those 10 days together, give them a reservation number, and then in our scraping, we'll do 1-day stays, we'll do 7-day stays, we'll do month-long stays. We'll see what the discount is for those. And so when we're estimating the revenue for that, we'll then apply the right discount back and given what that length of stay is. And then we actually show benchmarking for that. So you can look at any property manager and see, okay, this competitor's doing 10%, this one's doing 20%, this one's doing 30% on weekly or monthly stays, and you can see how they differ. And then length of stay trends has been a big one over the past 5 years. So average length of stay in general is about 4 days, but it can vary dramatically by market.
Yeah. So imagine we have a crystal ball here, and we're looking into this crystal ball for 2026. What are your predictions? And what is the data telling you?
It's a very lame prediction. I mean, I think that 2025 is a very stable year, and I think that 2026 is going to be a continuation of that. So it's nothing really exciting, but plenty for that, right? Plenty for a year without growth, right? A year where you're fighting for market share, right? You're not kind of like going into like green new pastures, right? It's all about market share. And so I think that's how the competitive landscape is going to look like in 2026.
So if you could give a property manager advice in relation to data and everything else for 2026, what should they continue to do or should do?
I mean, I think, expanding, revenue, not through inventory, right? But through like optimizing what you have, right? Or learning how to, maybe you can expand inventory as well. But, learning how to optimize what you have, I think is very important, right? Because that's where the competitive advantage comes from, right? It's not about acquiring more listings, it's about being better than your next door neighbor.
What actually is there a number out there? And I've been thinking about this for a long time. And as revenue management came into our industry, the adoption rate was pretty slow. But is there a high level number of, let's say, professional property managers who use revenue management solutions nowadays?
Yeah, I would say it's probably in like the 10 to 15% range.
What?
Yeah.
So I've got a number because we track all the rates for. Across the industry, we see it's about 30% using revenue management for property managers.
We're talking about price less.
It's about 60% that we see like high variability of like rates, and like we have a different for property managers. So those with 20 more listings, like very high. Not all. I think it's crazy that 40% of property managers aren't using.
Yes.
It's like
he says 90.
I say it's much lower, but I think
he says it's much lower.
Yeah. But we can define like what revenue, like what kind of pricing is differently, right?
Yeah,
I think that's the difference.
I've got but
So what does AirDNA's crystal ball tell us on 2026?
So I've got a whole 30-minute session tomorrow morning on the outlook for 2026, but I'll give you the highlights.
Yeah.
The World Cup is going to matter for next year.
Is it? I wanted to ask that question this morning because I'm not convinced, but it's
no.
You guys know how to play soccer in the US as well, right?
It's interesting. I don't think the soccer is going to matter much.
Okay, it's the party.
Yeah,
that's why I go look American football because of the cheerleaders.
Americans actually drove more inbound demand to Qatar and to Russia than any other country for the World Cup. So the fact that Americans aren't interested. Americans also have money and they're willing to travel, and it doesn't take a whole lot of people traveling to drive a lot of inbound demand. So, but you're going to see it, and I'm going to sort of call out tomorrow morning the top 10 countries that are going to see the drive inbound demand. And then, and that was sort of a joke, but my outlook for next year is maybe a little bit pessimistic, because I do think this year is the lowest supply growth we will see, and that there's some conflicting factors of home values are coming down, interest rates are slowly coming down, overall RevPARs have edged up, and that is making it more attractive for supply to actually come in. And I think we're going to start seeing more and more supply growth next year. I don't think demand is going to be able to keep up. So next year could be another negative year for occupancy, where this year was essentially flat, slightly positive.
Yeah.
And so if that happens, like pricing power could erode a bit more. And so our outlook is like 1% down on occupancy, 1.5% increase in ADR, which means RevPAR are up 0.5%. And like, if that doesn't come true, like maybe the supply doesn't come to head, like I don't think we're going to have much more pricing power. And like, so if occupancy's flat, we have 1.5%, 2% RevPAR growth, and that's the upside, and inflation's going to be 2.5%. Like it's not a happy story for most companies unless you're growing your inventory, unless you're scaling in ways to make your business more efficient.
How did your predictions at DARM 2024 compared to 25 come up?
Well, I wasn't
I've
invited.
written them
I didn't speak last year, so
But you made some predictions too.
I did. They generally came true. We called for occupancy to be slightly up with moderate pricing power. You look back on it, like occupancy predictions were spot on. What didn't come true were the pricing power. It wasn't as strong as we were expecting.
Yeah.
And I think a big piece of that was the erosion of occupancy on the lower tier listings, which was unexpected. It really, it happened after the Great Liberation Day. Uncertainty skyrocketed. People were really worried about inflation and what tariffs were going to mean for goods, for their fixed costs. They were going to have to pay anyway. And we saw them really starting to pull back on forward planning. They weren't willing to book. And Melanie showed it, like, you looked in May for forward pricing for the summer, like pacing was way down. Like August actually ended up positive, but it took a lot of discounting to get to it.
Yeah.
Verbo talked about it on their Expedia on their earnings call. Like the only thing that led them to have a good quarter was that they rolled out their discounting platform where they're allowing property managers to offer different discounts. Like Airbnb, again, they're like, it was looking to be a bad summer. We rolled out reserve now, pay later. All of a sudden, like people started booking, but like these are things that like only really work when people are feeling pinched.
Awesome. Guys, we unfortunately have to wrap this up. Also to the audience who is listening to us on the live stream, thank you very much for attending. Thank you, Jamie, and good luck tomorrow as well. And thank you, Pedro, and then have a wonderful Christmas period as well. I appreciate it.
Thanks all.